Welcome to another episode. I'm your host, Ryan Richards, a residential loan officer and real estate investor up here in New England. And today I'm bringing another solo episode to you where I'm deep diving into down payment assistance options for first-time homebuyers. How can you buy a house with little to no money down, and how I've helped clients do exactly that. So stay tuned if you want to learn more about how to spend little to no money down buying your first house. Hope you enjoy. So this is one of my favorite topics to dive into. As a first-time homebuyer specialist, I use a lot of the assistance programs, and there's quite a few different options. And ultimately, the programs can provide for down payment and even closing cost assistance. So you can buy a house with potentially little to no money out of pocket. I've actually had several clients who actually get money back at closing. Typical part of the real estate process. When you make an offer on a property, you typically make an earnest money deposit up front to bind the offer. So you do need some cash. But I've had a lot of instances where at closing, they actually get their money back. So you can buy a house with sometimes literally no money out of pocket. Now, how do you do that? Well, there's quite a few different programs you can look at. Ultimately, each state has their own subset of first-time homebuyer subsidized mortgages. And the goal is to provide down payment, closing cost assistance. But notice I said assistance, not necessarily grant funding. So what's the difference? Well, assistance typically has to be repaid in some form. And we'll go through a few different variations versus what a lot of people remember about the recent past is grant programs. So grant programs on the state level, money you get to buy a house that you don't have to pay back isn't widely available at this point in New England when I'm taking this episode, which is in September. But things can change quickly. Massachusetts had a grant program available a few years ago. It only lasted for about 8 weeks. They thought it was going to last about 8 months, where they gave $30,000, $40,000, $50,000 to first-time home buyers to help them buy the first property. Rhode Island similarly had a grant as of recent, also gave $17,500 to first-time home buyers in which you don't have to pay it back under some circumstances. But nonetheless, what we have now at the state level and really the federal level is options for no and low money down. So how does it work? Well, the programs by and large are structured as second mortgages. So what will end up happening is, let's say you're buying a house for $500,000 in a state like Massachusetts, for example. What they're going to end up doing is still requiring a minimum down payment on the first mortgage, but they'll come in with a second assistance loan to subsidize and cover your down payment. So let's use Massachusetts, for example. In Massachusetts, there are quite a few different programs that provide down payment assistance. Now, these are different than no money down programs. Those are 100% financing options, which we do have, but that's one mortgage. You still need closing costs under those examples. This is based on assistance loans as a second mortgage. So let's say in Massachusetts, you buy a house for $500,000. Well, the minimum down payment requirement as a first-time home buyer, assuming you don't have a different type of 100% financing, is 3%. That's the first-time buyer benefit, is 3% down minimum. So on $500,000 price, 3% would be $15,000. Now, closing costs, of course, can vary, but let's say closing costs are 2% of the price. So let's say you have $10,000 in closing costs, you need $15,000 down, you need $25,000 total. Well, in Massachusetts, there are programs that do provide $25,000 in down payment and closing cost assistance. So in essence, they'll give you a second loan to cover the down payment and closing costs. In this case, Massachusetts gives $25,000 to cover down payment and closing costs on a 15-year term at 2% interest. So of course, there are caveats as to who qualifies for this program and how. I can't guarantee you'll qualify for it, but there are options like this. So what that essentially does is allow you to finance 100% or more of the total price, right? Because if under that example, house is $500,000, you were putting $15,000 down, that's being covered by the assistance loan. and then they're financing an additional 2% of your closing costs. So in the end, between the two mortgages, you're financing 102% of the value, which we can talk about a little bit. It's really important to know when you're looking at these financing options that typically that second assistance loan is due in full when you sell or refinance. So that's really important to know and make sure you talk about with your loan officer. Because if you want to, let's say, refinance in a year from now, and the value of your home has stayed the same, when you go to refinance, you owe back the $25,000, but the value hasn't moved. And we just said you financed 102% of the value. So in order for us to come in and refinance that loan, you have to essentially pay back the $25,000 in order to refinance. So these types of loan programs are great for getting in the door, but you need to be even more particular about your monthly budget because the likelihood of a refinance in the short term is more prolonged. This is more of a longer term play on a property. You're looking for 3 to 5, 6, 7, 8 years, potentially even a lifetime property because of this caveat. It is due back when you sell or refinance. So really important to consider. You might have this payment for a longer period of time, but it gets you in the door. Now, where this program can be really impactful is let's say you find a property that's in B- condition. It's move-in ready. It's in a great area, great neighborhood. You love the layout, but it needs some TLC. Maybe you need to you could redo the bedroom, redo the bathroom, redo the kitchen. You could add some paint, make some upgrades, and put some value into the property. That's where this type of program can really have a lot of benefit because what you can do is use the assistance loan to cover all of your upfront costs to purchase the property, leaving your cash to go in and renovate the property. And renovating the property can then force appreciation, make your property worth more money so that when you go to refinance in the future out of this program, now that $500,000 property is worth $550,000 because you put your money into it. So at that point, if you refinance, we can just take the $25,000 loan and put it into a new one. So we can roll it into the new mortgage. You don't have to come up with that money out of pocket. So when you're talking about highest and best use of your cash, that's where these programs I think can be most advantageous because it gives you the ability to free up your cash to go put into higher value activities like renovating your property. Because $25,000 into a property in the right way can lead to multiple returns in terms of a higher value. Similarly, I have some clients who say, well, if I can borrow the money at 2%, why wouldn't I do that? Even if I had the $25,000, it's at 2% interest. So you could take $25,000 to cover all your closing costs and down payment. You keep your money in the bank, even in a money market fund earning 5%. And now you have the theory of arbitrage. You're making a spread between the cost of your money, in this case, 2%, and what you can earn on it, 5%. So you're making a 3% spread. The arbitrage model is very common in financing and business and whatnot. But things to think about. Really important to consider the fact that it's probably going to be a longer term play and you're probably going to have your monthly payment as is for a longer period of time because of that $25,000 being due when you sell or refinance. What's also important to consider is that although you can get into a property for, in this case, literally no money out of pocket, it's important to make sure you keep some cash available. Buying a house and having no money in the bank after closing is definitely not something I would advise. We certainly can do it. I have had people who do that. But if the water heater breaks or goes 2 weeks after closing, you have to pay that as the property owner. You have to keep the hot water going. You want hot showers. You want hot dishwasher, hot sink. You need that water to be hot. So you have to pay for that. And where's that going to go to if you don't have an extra cash reserve? So definitely have a cash reserve position if you're going to go in at 100 or 102% financing, because if the property starts to become cash intensive for you, you need to fix a leak in the roof. Maybe you have to fix a new water heater. You can't just sell the property because you've already borrowed all of the money. You borrowed 102% of the price. So if you go to sell it, in a position where, again, you won't potentially have enough equity to be able to sell and not take a loss. So it's just something to really think about there. I don't think it's talked about often. But nonetheless, it's a super awesome option if you want to preserve your cash out of pocket and keep some cash in the bank. It does make homeownership a lot more accessible, but just important to know all the implications of financing 102% of the property value with no plan to increase the value over time. That's just one example. So Massachusetts, as I mentioned, $25,000 to sometimes even $30,000 in assistance. And this is by and large the same type of structure across most of the northeastern states, which is where I focus. I can't really speak to any other states that, of course, I'm not licensed in, but there really are two structures that we look at for the assistance loan. The first one I just mentioned, where it's $10,000, $15,000, $20,000 in assistance, $25,000, $30,000 in assistance. And it's either like the example I mentioned, where it's on a fixed term, in this case, 15 years, and at a discounted interest rate, in this case, 2%. So there's a term and a rate. It's a typical second mortgage. Minimum monthly payments you make, you pay it back over time, over the term, and it's paid off. That's one type of assistance structure. The other type of assistance structure that we see often is in Rhode Island, for example. They'll provide $15,000 for down payment and closing cost assistance on what they call a deferred second mortgage. So essentially, they're giving you, in this case, $15,000, but there's no required monthly payments. There's no interest on the money. It basically just sits there and waits until you sell or refinance. So they're giving you the money now to help you get into the house. And they're saying basically, look, don't worry about paying us back every month. Don't worry about paying us interest. But when you sell or when you refinance, we want the money back. So it's called a deferred second mortgage, which can be really advantageous for the same types of examples I just went through. If you can take $10,000, no interest, why wouldn't you do that? I mean, of course you would. But these types of programs have limitations. Not everyone can qualify. In most cases, you have to be a first-time home buyer, although not always. There are income limits for the program. So each county, each city, Rhode Island's pretty small. It's generally the whole state, but there are different income limits based on the geographical location based on the program. So they typically fall within what we call the area median income of a general area. So, for example, area median income limit for some of these programs in a county like Worcester County might be $127,000 as borrowers on an application. So whereas Rhode Island might be more flexible and be $135,000 if you have a couple people living in your house. So there's different factors, but typically, these programs are limited by income limitations, and there are credit score minimums. So credit score minimums meaning you have to have a minimum credit score to even be eligible for the program. But they're pretty flexible. Typically they're in the 640, 660, 620 range. They do provide some flexibility there. Now, of course, as you're listening to this, I always have to put the mortgage loan officer disclaimer that you might not qualify for any of these programs. Your rate might be 20%. Of course, we don't know, right? I'm not saying everyone listening to this can get approved for one, but it's important to consider them and talk to a loan officer who has experience in those programs because they tend to be very nuanced. There tends to be a lot of moving parts within those programs that if you're not familiar with, you can trip on. But I think what's even more of a guilty sin of some people in the industry is they don't look at them as an option because they don't know them or their company doesn't have access to them. Not every company has access to all of these programs. So it's really important you make sure as a first-time buyer that you've checked all the options and you're talking to a loan officer who has experience with these programs and can give you some guidance on why it might be beneficial to you. What are some of the drawbacks to the program? Why, from a financial sense, could it make logical sense to take out some of these assistance loans? Like the examples, I just went through with using your cash for other higher earning potential than putting it towards your house down payment. So some things to consider. There's numerous other options. New Hampshire has a few different cash assistance options. Connecticut has a few different options as well. Massachusetts, Rhode Island are my specialties. Certainly some great options available there. And one thing to look into as well, it's not something that a mortgage company would help facilitate per se, but there are local city grants available. City of Worcester has grant funding. The city of Greater Boston, Providence, East Providence, there are grant programs available, but they're funded by the city. So that's something you have to come to your mortgage company with and say, I have approval for this amount from the city in a form of a grant. Can I use it? And the answer, of course, would be yes. So important to make sure you ask your loan officer about some of those options. The only downside I would say to those programs is they tend to be very conservative on how much you can make to be eligible. So a lot of times they're not an option for people because they disqualify on one factor or another. There's even asset limits. You can't have more than a certain amount of liquid assets available to be able to use those grant funded programs. So something to look into, but again, not something that a mortgage loan officer like myself would help you go get. That's something you come back to us and say, I have this. We can certainly give you lists of where to find them. So if you want that list, send me a DM. on Instagram or text me if you have my number, and I can send you the list of where to look for grant programs and see if you might be eligible. But definitely something you want to be proactive on. Sometimes they can take a few months to process that application. So you definitely want to have that secured ahead of closing on a property. But all in all, these programs can be very beneficial. I've helped many people utilize them and buy houses with little to no money out of pocket. But it's really important you talk to the right person to make sure you get the right guidance on how to use them, the positive and negative implications of doing that. So you make sure you make the best possible decision for you and your family on your new home purchase. As always, I hope you enjoyed listening. Hope you took something valuable from this episode. If you ever want to talk mortgages, learn more about your specific scenario, what types of programs you would be eligible for, reach out to me. I'm happy to walk you through it. If you enjoyed this show, please do make sure you leave a rate, comment, and review. That's how this show gets out to more people so we can continue to shed light on the real estate industry.